From 2006 to 2012, the United States grappled with its most significant real estate downturn since the dark days of the Great Depression. This pivotal event not only reshaped the international economic landscape, inducing a profound recession that rippled beyond American shores, but also impacted nations globally. While historians, analysts, media outlets, and filmmakers often zero in on the financial catastrophe itself, there's a relative dearth of discourse about the periods preceding this downturn, the so-called real estate bubble era. During this time frame, U.S. property values embarked on a steady ascent, which exponentially accelerated post-2002. Suddenly, the real estate sector emerged as the modern-day gold rush, with valuations skyrocketing daily, culminating in bewildered, disheartened, and vexed consumers. For a vast majority, it's undeniable that post the 2012 crash, the market commenced a phased recovery, becoming more pronounced and explosive post the pivotal events of 2020. The wider populace is acutely aware that this current trajectory is a deviation from the norm. Evidently, we appear to be sailing through the tumultuous waters of another economic bubble that, in hindsight, seems to be approaching its zenith, heavily punctuated by speculation, aggressive financial maneuvers, and palpable greed. Contrary to the narrative popularized by Hollywood blockbusters, a vast spectrum of individuals had foreseen the impending financial storm. Amongst these forecasters, it wasn't just niche groups that were sounding the alarm bells. Numerous prominent investors and even lay people discerned the fragility of the market. One such visionary was Warren Buffett, frequently hailed as the world's most astute investor. At Berkshire's 2006 annual assembly, he articulated his reservations about the real estate market, drawing eerie parallels with today's American landscape. He underscored the risks, highlighting that the central issue wasn't ordinary home buyers, but rather speculative real estate investors wielding aggressive leverage and driven by unrestrained ambition. Reflecting on the ebb and flow of property markets, Warren Buffett once remarked, "In prime areas like New York, we've seen notable market shifts over the years. There's an apparent cooling trend universally. The luxury segments, largely propelled by speculative purchases, feel this the most. Picture buying a house for $100,000, taking a mortgage for $270,000, only to watch its value plummet to $250,000. Now, if you have a stable job, moving isn't top of mind. Yet, as the digital era unfolds, the day trading methods once confined to stock markets have seeped into real estate, ushering in unprecedented market swings. What starts as a market pause inevitably picks up, but with more pronounced highs and lows."
For quite a while, and that's part of banking. I mean, you expect to lose some money in banking. It's not a sure thing on every loan, and you build that into your calculations, and then you have capital that protects your depositors from it eating into their money. And if it does eat into their money, then the FDIC, which is in effect really a mutual insurance company of a very peculiar sort, essentially spreads the losses among the continuing banks by higher FDIC assessments in the future.
Buffett's analysis zeroes in on the pivotal role of investors in this market metamorphosis. They've transposed the frenzied logic of stock trading onto the realm of real estate, leveraging their positions and chasing ephemeral gains. Recent studies point to an unprecedented surge in investor activity. Many resort to high-risk, occasionally covert, financing tactics, encompassing perilous and potentially deceptive loans. Buffett emphasized the uniqueness of the real estate sector compared to the stock market. While stock prices are real-time reflections during weekdays, real estate operates on comparables, frequently derived from a smattering of recent transactions. This modus operandi can induce rapid market shifts. Picture a scenario where an inflated price is agreed upon by an ill-informed or overly bullish buyer. This solitary transaction could potentially set a new pricing standard for an entire neighborhood. However, once the tide starts to turn, the descent can be swift and severe. Every significant economic bubble, characterized by soaring valuations, is invariably followed by a substantial downturn. The core issue remains constant: extending credit recklessly to overly enthusiastic or avaricious individuals. Surveying the contemporary real estate landscape, there's a burgeoning trend of investors securing loans for underperforming Airbnb properties, non-profitable property renovations, and assets yielding negative monthly returns. Warren Buffett and Charlie Munger, during a noteworthy Berkshire Hathaway symposium, flagged such lending behaviors as ominous harbingers of looming market crashes. Buffett, with his characteristic sagacity, likened such lending practices to latent ailments that could suddenly unleash widespread financial pandemics. Munger reminisced about the ill-conceived lending stratagems of the 1980s, which precipitated financial sector meltdowns. He stressed that developers with profit-centric tunnel vision would invariably chase opportunities, provided they secure their desired financings, often without long-term viability assessments or inherent risk considerations. Buffett and Munger's insights serve as a beacon for contemporary times. Careless lending invariably triggers severe ramifications. While such repercussions might not manifest immediately, when they do surface, they're intense and often devastating. Looking back at our current situation, it's evident that the forming economic bubble mirrors the one from the early 2000s. While the backdrop might differ, it's a well-acknowledged fact that history, even if it doesn't replicate itself exactly, often follows analogous patterns. Precarious lending, fueling the ambitions of speculative investors across various hotspots nationwide, is propelling the recent steep price shifts. Sooner rather than later, this meteoric rise is bound to witness a drastic correction. A characteristic of real estate bubbles is that their growth and declines are seldom linear. When the tides shift, the transition is instantaneous, rendering the financial journey agonizing for many. Steep ascents invariably portend equally precipitous declines. I'm deeply appreciative to everyone who's followed this discourse to its conclusion. If you found value in these insights, kindly demonstrate your support by liking and subscribing to our channel to stay abreast of our financial explorations. And, as always, share your on-ground observations and experiences in the comments section below. Your engagement is the lifeblood of our community.